Good morning and welcome to our general mathematics class. Today we'll talk about another aspect of basic business mathematics. And it's a lesson that I think most of you commonly heard about. It's about stocks. Now, let's start with reciting today's memory verse. It's found in Proverbs 13 verse 11. It says, "Dishonest money dwindles away, but whoever gathers money little by little makes it grow." For your MVCA boosters today, you need to think of one way to invest your stocks, to invest your money, and it is to buy stocks. Aside from money, there are still other things that we can invest. Think again. What can you invest for the Lord? And how can you invest them? At the end of today's class, we'll be able to illustrate stocks, describe the different markets for stocks, analyze the different market indices for stocks, and the last is interpret the theory of efficient markets. Let me show you a sample of the stock path. This one. I think most of you have seen this in televisions, and if your parents are into trading, you'll commonly see this one. This is a sample figure of the trend of Philippine stocks in 2020. So you'll see it goes up, it goes down drastically, and it slowly goes up. If you are a stockholder or a broker, at what month is it best to buy stocks? And at what month is it best to sell stocks? And why do you think so? You might think that you don't want to sell your stocks when it's at the lowest point. Selling price is very low. You want to sell stocks when it's very high. And you also wanted to have a low buying price, right? So you want to buy stocks when price is really low. Now, let us first define some terms today. The first is commission. A commission is a payment to an agent or salesperson based on the value or quantity of goods bought or sold. For example, let me use this in layman terms. You are selling puto and you sold puto at 5 pesos per piece. Then you might ask the seller, the one with whom you bought the puto with, how much is my commission? And the one will say, your commission is 1 peso per puto. So if you'll sell 20 putos in a day, then you will have 20 pesos for your commission. So commission can be based on the number of quantity of goods being bought or sold. Or another is sometimes commission is based on the total amount. For example, for real estates, like the ones who are selling condominiums, you know what? Why there are so many people doing that? Because commission is very high. For example, in some real estates, the commission is up to 10%. So if a condominium is sold at 2 million pesos, if they'll get a buyer, that's automatically 10%, 200,000 commission to the one who's making the real estate. How much more if they'll sell more condominiums in a day? So imagine the commission of that. It's also called the brokerage fee, the broker's fee, or the brokerage fee. It is based on the percentage of a sale. Now, what is a broker? For example, I own a house and I want to sell it, but I don't want direct selling because I'm not good in business. So I hired a middleman who will sell in my behalf. This middleman is called the broker. So the broker will sell my house in my behalf. So because he or she sells that, then I'm giving that broker a broker's fee, or some would call it brokerage fee. The next is loan. What is a loan? A loan is an arrangement in which the lender gives the money to the borrower in exchange for a future repayment along with an interest and other financial charges. In our layman's term, we call it utang. But you know what? Sometimes our utang are not mathematically utang. Why? Because in utang, once you will repay with a tubo, with an interest and other financial charges. So for example, if I'll utang 1,000, then possibly I'll return with 1,100 pesos. But sometimes our utang is like this. I will utang 1,000, I will also return 1,000. No, that's not utang. It's simply borrowing for a meantime, not the mathematical loan. Now, there are two possible perspectives for loan. It's based on the investor and the bank. For example, if we deposit our money to the bank, we see it as an investment because our money will increase there. But for the bank, they see it as a loan. They are loaning something from us so that they can also lend it to someone. Now, if you borrow money from the bank to buy a house or a car, we see that as a loan. Because example, if I'll loan 1 million, possibly I'll repay with 1.3 million. But for the bank's perspective, it is their investment. They are lending you the money, and in return, their 1 million will turn into 1.3 million. So loan and investment will depend on the perspective. Who is the one taking the interest? That is the investment. And who is the one giving the interest or paying the interest? That is the one who made the loan. Now let us have an example. Dan Rev sells books on weekends. He is paid a straight commission of 20% on his sales. In April, his sales amounted to 10,000 pesos. How much was his commission? Remember that commission is the rate, the percentage, times the total sales. You know what? My examples are personally made. Dan Rev is the name of my classmate who is a student LE every summer. So the commission is 20%, 0.2 of the sales, times the 10,000 sales. Most of you commonly do this in PPH, right? During summer. Then Dan Rev will receive 2,000 pesos as his commission. Any questions? Feel free to raise your hand if you have questions, okay? Let's go to the next definition of term. What is a stock? A stock is a financial asset that represents the ownership to the corporation and claim in the firm's earnings and assets. Here, once you'll buy stocks, have you seen stocks for sale? Like you open a newspaper, you'll see there Jollibee Corporations, SM, Ayala Land. If you'll buy a stock, it means that you are buying ownership rights to a certain company or corporation. So if you are a stockholder, you are automatically a co-owner of that company. Now, how do stocks earn? First is through dividends. For example, if the company has 1,000 stockholders, and let's imagine that each stockholder only holds one stock, which is impossible, right? If the company will earn 1 million pesos, then that 1 million pesos will be divided to all the number of shares the company has. So if the company has 1 million and there are 1 million shares, that's 1 peso per share. And if you own 100,000 shares, then you will earn 100,000 for your dividend. Another is the stock yield ratio. It's the ratio of the annual dividend per share divided by the market value per share. It's also called the current stock yield. Let's have some examples as for some different types of dividends. The first type of dividend is the cash dividend. It's the most common. I told you a while ago that if the company sells 1 million and there are 1 million share stocks being held by the company, then you will be paid 1 peso dividend per share. That is cash dividend. The other is stock dividend. In order, instead of receiving that cash as a profit, you'll receive more shares. For example, let's go back to our example of the dividend is 1 million and the number of shares is also 1 million. So you'll receive 1 peso per share. For example, the company is selling stocks at 10 pesos per share. So if your dividend is 1 peso per share, and let us say that you have 1,000 shares, so your dividend will be 1,000, you can convert your cash dividend to stock dividends. So instead of receiving 1,000 pesos in cash, you will receive, divided by 10, you'll receive 100 shares. The next is property dividend. For example, if the company has land or some equipment, then instead of giving you cash dividends, they can just simply divide the property dividend. It is recorded at the fair market value and estimated market value that the buyer is willing to pay the seller. The next is scrip dividend. This is a note of obligation to pay or a promissory note, which may include interest to pay shareholders at a specific date. For example, let's go back to your 1,000 possible dividend. But then the company could not pay you this much. So what will happen? They will make a promissory note that they will pay your dividend with a certain interest rate, example 10%, and when. That promissory note is called the scrip dividend. The next is the liquidating dividend. This dividend returns the stock investment. It is usually a sign that the company is winding down its business. Thus, the company distributes its asset to rightful owners, including the stockholders. So it means that the company is palugi. So what will happen? They will return you your stock investment. Sometimes the returning is not in cash, especially if your company is declaring bankruptcy. Sometimes as you see in televisions and in K-dramas, the division might be in properties, in equipment, in facilities, and not totally in cash. Let's have some examples. A certain financial institution declared 30,000 dividend for the common stocks. There are 700,000 shares for the common stock. How much is the dividend per share? To solve for the dividend per share, that will be the total dividend divided by the number of shares. So if you have a total dividend of 30 million, you divide it by 700,000 shares. That will amount to 42.86 per share. Now, ma'am, how much will I receive? I receive It depends on your shares. So for example, if you own 1,000 out of the 700,000 shares, then you multiply the dividend per share by 1,000. That is the amount that you will receive for a certain period, usually for a year or for a quarter. Again, that's every year or every quarter. So your stocks are just there. It keeps on piling up through the dividends. The second one, the third example, a certain corporation declared a 3% dividend on a stock with a par value of 500 pesos. Mrs. Lingan owns 200 shares of stock with a par value of 500. How much is the dividend that she will receive? Now, if you see there's the percentage, the par value, the value of the share, and the number of shares being owned. So how will our dividend be computed? That's going to be the percentage, the dividend percentage. You multiply by the par value. You multiply by the number of shares. So for this problem, that's 3%, 0.03, multiplied by the 500 par value times 200 shares. So Mrs. Lingan will receive 3,000 as her dividend. You might say, ma'am, that's very low. You see, that's 500 pesos times 200 shares. That's about 100,000, right? But you see, the 3,000 dividend might increase or might increase in the next year. So as long as you're a stockholder, you keep on receiving dividends. The next one, Corporation A, with a current market value of 52 pesos, gave a dividend of 8 pesos per share for its common stock. Corporation B, with a current market value of 95 pesos, gave a dividend of 12 per share. Use the stock yield ratio to measure how much dividends shareholders are getting in relation to the amount being invested. How do we solve the stock yield ratio? The stock yield ratio is dividend per share divided by the market value. Now, what is the market value? If you notice in newspapers, it will say Jollibee is selling its shares at 1,000 per share. That 1,000 per share is called the market value. So let us compute for Corporation A. For Corporation A, that's 8 pesos per share divided by 52 pesos market value. For Corporation B, that's going to be 12 pesos per share divided by 95 pesos of a market value. So computing, you'll have 0.1538, or that's 15.38% for Corporation A, and for Corporation B, that's only 12.63 or 12.63%. What would it mean? It means that Corporation A has a higher stock yield ratio than Corporation B. So if all benefits of both corporations are equal, it is wiser to invest in Corporation A. Why? Because in Corporation A, each peso will earn more. You see, it's at 15% compared to 12% posted by Corporation B. Any questions? No questions? Let's go back. Let's go next to the parts of a stock certificate. Once you'll be a stockholder, you will receive a stock certificate. Now, what is a stock certificate? A stock certificate tells you that you are a co-owner of that corporation. It means that it's a certificate of your co-ownership. And automatically, you are called a stockholder or a shareholder. Now, what can be seen in a stock certificate? This number here, the JC84, is called the certificate number. Then, so it is like we say the control number. So if it's JC84, the next can be JC85, the next can be JC86. No certificate has the same number. The next is the Spencer Shoe Corporation. This is the corporation issuing the certificate. So for example, if you buy stocks from Jollibee Corporation, then you will see here Jollibee Corporation or Robinson's Corporation or Ayala Lands. It depends on where do you want to invest your money. Next is here, the name of the stockholder. So if I will invest, it will place there Lil Gem Pandara. Next, the number of shares. How many shares did I buy? This will be 100. Then the par value. How much is the amount per share? Example, $1 each. The next is the signatories. Who will sign? Who signs your certificate to say that it's a legit? So we have the signatories. And you also have the seal of the corporation. The next one is the type of stock. The stock can be common stock or it can be a preferred stock. Now, how are they different? How are they different from each other? Let's start with no par stock. If you say no par stock, it means it's a stock issued without a stated value of the certificate. It's an open stock. Usually it's given as a gift. The next is the preferred stock. The preferred stock tells you that you get the preference for the dividends, but you don't have any voting rights. So for example, your corporation only gets 1 million. It's not enough, right, for all the shareholders. So those the ones who will get the dividends first will be the preferred stockholders. However, they don't have any voting rights. In the common stock, you will just get the remaining stocks, okay? Whatever is being taken by the preferred stock at a certain percentage, then you'll get it. For a friend told me that you can do it this way in trading. Example, I will invest 1,000 pesos. And I'll say that I have it at preferred stock with 8% interest. So what will happen? Out from my 1,000, I will automatically get 80 pesos. Let's make it higher. I'll invest 1 million. So if I'll have it at 8%, I will automatically get 80,000. Whether the company earns as much dividend as that, or even if they don't have. Suppose there are many of us who are in preferred stock. No matter what will happen in the company, even if it will sink or even if it will be very successful, I will just get that amount based on the percentage. So out of those, they will take it. What's left in the dividend will be divided by the common stockholders. What are the disadvantages? The advantage for the preferred stock, you will get your dividend. The disadvantage, there's no voting rights. For the common stock, you'll possibly have less dividends. The advantage, you will have voting rights. So you can be a part of the company's board of directors, or you can be the next CEO. It depends on if you are a major stockholder. The next one, the market price. The market price or the market value is the price at which a stock is sold. It's also called as the stock price. The next is trading. Trading is the process of buying or selling the stocks. And the one who sells the stocks on your behalf, you call that the broker. Next is the IPO, or we call it the initial public offering. The IPO is the stock sold before it is available on a stock exchange. Okay, for example, I will, because you see, I could not, if I'm the corporation, I could not sell directly to the stock market. I need to get through a bank. So I'll channel to the bank, and then the bank might buy some of my stocks before it will be available in the stock market. Now, what is a stock market? A stock market is a place where trading occurs, the buying and the selling. And all of this, the results of the stock market are being shown in the Philippine Stock Exchange. Now, we only have two stock markets, one in Ayala Tower 1 and one in PSC Center, Pasig. So all the trading happens there. It looks like this one. There's a very big monitor in front where the stock values will change from time to time. And then here at the platform, these are the brokers. The SEC is what we call the Securities and Exchange Commission. It's a government agency that protects and maintains the capital market's integrity, including the stock market. So they make control of the stock prices and the buying and also of the selling. Sorry. Now, there are 4 participants in the stock market. The first is the Philippine Stock Exchange, being controlled by the SEC or the SEC. Next is the publicly listed corporations, who are the ones selling. The next is the trading participants, the brokers, and the last will be the investors. So what will be the transaction process? The investor will buy or will sell. Then the broker will transmit it to the buying or the selling, the Philippine Stock Exchange. Then the Philippine Stock Exchange sends a confirmation to the broker or to the trading participant. Then the broker confirms the trade with the investor. So it looks like this one. If I am the investor, I will call the broker. The broker will call the PSE. And once confirmed, the PSE will call my broker, and the broker will call me to confirm that the trading is successful. Now, what's the formula for the total cost of the stock? It's going to be the market price plus the commission. Example, Mang Juan bought 100 shares. 100 shares at BDO Unibank at 114.20 per share. The broker charged him 125 pesos as the commission. What's the total cost of the stock? It will be the number of shares, this one 100, you multiply the price per share, 114.20, then you add the brokerage fee, the 125 pesos. So for the shares alone, Mang Juan paid 11,420 pesos. You add the brokerage fee of 125, so you'll get 11,545 pesos. That is the total cost of the stock. Ma'am, can anyone be a broker? If you're an ABM student, some would go to become CPAs, and later you can take the broker's examination. The broker's exam will help you to become a good broker. And with that, you can earn, you say it's too low, 125 pesos. But how many people are you trading each day? So they say that some of the richest people are brokers. Now, how do we read the stock table? The stock table can be taken from the internet, or another is you buy a newspaper. I've seen it in Philippine Daily Inquirer, and you'll see the PSE, the Philippine Stock Exchange for the previous day. So today I'll receive for December 15. Now, how will I read the Philippine Stock Exchange table? You see it in the stocks, Banco de Oro, that's BDO. It's the name of the corporation. Or let us find another here, ABS-CBN, it's a corporation. Or another, Sun Life Insurance Company. These are corporations. The 52 weeks is equivalent to 1 year. So example for Banco de Oro, you'll see that the highest trading price is at 54.50 for the past year, from yesterday to the past year. The lowest is at 45.80. You'll see the par value, that's the face value of your stocks. The close, the previous close is yesterday. At what price did it close? So at the closing time, it's at 54.80 pesos. It opens at 55 pesos. Mind you, in the stock market, stock prices might go up or down, up and down. The highest is at 56.7 and the lowest is at 55. So if you are buying, you want the lowest price. If you are selling your stocks, you'll have it at the highest price. Then the volume. The volume will tell you how many stocks were being sold yesterday. The value tells us how much money did the corporation get out of buying and selling of stocks. So that is how you will check on that. Once you will look at the volume, do not mind, because you see some are being sold at a very small amount. The example, Cebu Holdings, 2.57. Philinvest, 1.15. But if you'll check with others, like Banco de Oro, that's 55 pesos. We even have PBCom at 84 pesos. And even Union Bank at 61.50. So the price in the stock market would change from time to time. Now, how do we read the stock table? Example, we give the highest and the lowest prices for the past 52 weeks. The highest is 116. The lowest is 82. How about the highest and lowest price yesterday? Highest is 114.90. Lowest is 113.30. And what was the price at closing? Look at the close. That's 114.30. Let me first stop. Now, in the trading, it's not only buying of stocks, but we also have selling of stocks. Now, when do you want to sell your stocks? Number one, you want to sell your stocks basically when you notice that the corporation is already going down. Second, I don't want to say anything about ABS-CBN, but if you are one of the stockholders, what might you do? Now, the second is you want to sell your stocks if you really need the money. Now, however, it's not a guarantee that the amount that you invest in selling the stocks will be the same amount that you will get when you bought the stocks is the same amount that you will get after selling your stocks, because it depends on the market price. Like for example, I bought the stocks at 100 pesos per share. And this time, as I check, it's still at 100 pesos. So you call it break even. You don't have any other profits. You don't lose also. But if we say the market price is at 94 per share, say you will lose 6 pesos per share. But for some, they call it, it's better compared than having nothing at all. Or another is, it's possible that the market price is increasing. at 110 per share. We call it the premium. It means that you'll get more of the market price compared to your buying price. Now, how do we compute for the amount that you'll get after selling your stocks, the net proceeds? That's going to be the market price minus the expenses. What possible expenses can you incur? Example number 1, you will pay for the broker, the commission, right? Second, you'll pay the SEC, like the transfer of certificates, the processing, the taxes. You'll pay all of this. And these are all your expenses, like the taxes and the SEC fees, in order for your stock to be transferred to another's stocks. But here's a problem. Example number 6. The Transportation Corporation sells 300 shares at 320 per share. Commission, taxes, and SEC fees amounted to 2,240. How much is its net proceeds? It's going to be the market price minus the expenses. So how much will be the market price? That's 300 shares times 320 per share. So your market price will amount to 96,000. You subtract the expenses of 2,240, you will only get 93,760 pesos. Any questions? Ma'am, how big or how small can the expenses be? It depends on the corporation, and it depends on the number of shares that you own. So the last part of this topic is the theory of efficient market. The theory of efficient market is also known as the efficient market hypothesis. It was developed by Eugene Fama in 1960s, that states that the stock market reacts very fast to any information. Like, for example, if you are you have a fan of K-dramas, you'll commonly see this one. If the economy of Korea is going down, stock market is also going down. But if the economy is going up, then the stock market, the stock prices also go up. Another, for every corporation, if there is a rumor in the corporation, it's possible that the stock price will go down. But if the corporation is very successful, it has many good news, then possible that the stock price will also go up. So to any information, whether it's economy, whether it's popularity, whether it's a scandal, the stock market reacts very fast to that. That's why if you see the sample of the board, the numbers will automatically go up and down. At a given period, the market contains the total views of all the investors, and the proponents of the theory believe that the current price of the stock market is an accurate reflection of the investor's knowledge about the stock. Now, there are three forms of efficient market theory. The first one is the weak form of the efficient market theory. This form asserts that stock prices already incorporate all past market trading data and information together with the historical price information only. And the determination of price using historical performances is called technical analysis. Example, Neil Santos started to become interested in the stock market after watching a clip on the internet. So he chose to invest at BDO Corporation because based on his reading, based on his video reviews, BDO has outstanding performance in 2016 and 2017 with a consistent increase in their stock price of 10%. So he bought the stocks at 114 pesos per share in 2018. But in 2020, the stock price went down from 114 to 80 pesos per share despite its historical performance. It means that the market is weak form efficient because the past performance did not guarantee a return to nil. It says that the past marketing data, the past trading data, the past trading price and performance will not determine whether you'll get more or less in your present stock market. That's why you notice the curve, the graph, it could go up, but it could drastically go down as well. The second form is a semi-strong form of the efficient market theory. It asserts that the stock prices already incorporate all publicly information only. Fundamental analysis analyzes the various public information about stocks. So it's not all about the market alone. It talks about other news that are being taken. Example, Mayan Santos invested 50 shares of Jollibee Corporation. A week after the exact news, she heard that Jollibee went viral over social media and public news due to a food mishandling incident. Let's remember the chicken towel of Jollibee, that viral thought. After reading the news, Mayan sold all his shares for only 85 pesos per share. She thought that she avoided losses in the stock market. However, the next day, the stock price of Jollibee went to 100 pesos per share. The market already adjusted the moment the bad news was announced a week before Mayan heard the news. The public already reacted to public information, and Mayan should not have used public information to predict a possible stock price decrease. It's possible that during the time that chicken towel was being told, the stock price went down, and Mayan already heard about it 1 week after. So possibly during that span of time, naka-recover na ang stock price. So it already went up. The next is the strong form of the efficient market theory. It asserts that stock prices incorporate all the public and private informations. And when the market is at this level, nothing can predict the future stock prices and returns as contradicted with weak form and semi-strong form efficiency theories. Example, Jose Bernardo is the chief financial officer of Luz Biminda Bank. He projects that 2017 will be a successful year of the bank because of a substantial deposit and loan availing signed with a large corporation. Because of this, he bought 5,000 shares of the stocks and put all of his money on his investment. He was very confident in the increase of the stock price, but after a month, the stock price did not increase. The market already adjusted, and it incorporated the net present value effects of the deposit and loan availing of the large corporation. Now, what takeaway will I give you when you invest in stocks? Some of you might be invested in stock trading. Some of you might be fearful of what will happen in the stock trading. But let me have this piece of advice. Do not place all your eggs in one basket. Again, do not place all your eggs in one basket, because when the basket will fall, the eggs will all break. What's the point of the takeaway? When you invest, do not invest all your money in just one corporation, because when that single corporation will fall, the rest of your investments will also break. So that's it for this morning.